So why are you actually investing? It's a question we hear all the time, right? But the answer is rarely about the money itself. Are you trying to fund an 8-year-old's dream of becoming a space scientist? Maybe you're a 45-year-old engineer who just wants to make sure you actually survive retirement. Or maybe you're a young professional saving up to buy that very first house in a brand new city. Look, if you don't know your absolute true financial purpose, there is literally no mathematical formula out there that's going to save you. Welcome to The Explainer. I am so pumped to guide you through this fascinating material today.
Let's start with a massive reality check. Grab 10,000 rupees today. Now factor in an inflation rate of 8%, which, by the way, is completely realistic over a long horizon. In 30 years, you are going to need over 1,600,000 rupees just to buy the exact same goods. Let that sink in. Your purchasing power is constantly being eroded by this invisible thief. Over time, hiding your cash under a mattress pretty much guarantees that you are going to lose.
And honestly, that is exactly why we are embarking on this journey right now. In this explainer, we are going to completely demystify the world of investing and mutual funds. We're going to take what often feels like a ridiculously complex financial maze and turn it into a clear, straightforward roadmap. We'll see exactly how your life's underlying purpose connects straight to the legal and financial structures designed to protect your wealth.
Okay, here is our roadmap for today. First, the why of investing. Second, asset classes and their risks. Third, the mutual fund advantage. Fourth, exploring mutual fund types. And finally, number 5, the legal safety net.
Let's dive right into Section 1, the why of investing, and how to overcome that invisible thief.
You know, people toss around the words saving and investing like they mean the exact same thing, but they really don't. Saving is fundamentally about safety. It's about reducing what you consume today so you have cash tomorrow. Investing, on the flip side, means you're taking on a calculated amount of risk with that saved money to actually seek a profit. Obviously, you have to save before you can invest, but saving alone, that's not going to beat inflation over the long haul. At some point, you have to cross that bridge into investing.
Now, what's truly fascinating here is that our own human behavioral biases are often the biggest villains in our financial story. We tend to just follow the crowd, right? That's herd mentality. We also suffer heavily from loss aversion, meaning the pain of losing 5,000 rupees feels vastly worse than the joy of gaining 5,000. That fear makes us miss out on profitable opportunities. Add in a healthy dose of overconfidence plus recency bias, where we just assume whatever the market is doing today is what it will do forever, and it's a mess. We literally have to design systems to bypass our own flawed emotions.
Moving on to Section 2, asset classes and their risks. Essentially, the weapons in your arsenal.
So, if inflation is the enemy and our own emotions are the obstacle, we need some serious financial weapons to fight back and build wealth. Broadly speaking, there are 4 major asset classes. First is equity, which is literally ownership in a business. It's high risk, but it offers high historical returns. Then there's fixed income, where you're essentially lending your money out for interest, lower risk but with steady cash flow. Real estate is highly dependent on location and notoriously illiquid, meaning it's tough to sell in a hurry. And finally, commodities, like gold. They have global pricing, but they generate absolutely zero current income while you're holding on to them.
But listen, every single financial weapon has a recoil. There is absolutely no such thing as a risk-free investment. Holding cash, you're facing inflation risk. Buying real estate, you've got liquidity risk if you need cash fast. Corporate bonds carry credit risk if the company defaults. Stocks obviously carry market and price risk. And even safe bonds carry interest rate risk because if overall interest rates go up, the value of your bond drops. The bottom line, you cannot eliminate risk, you can only manage it.
And the primary way we manage all that risk is through asset allocation. By blending different asset classes together, we're basically blending their different risks. A classic example is the 60-40 split. That's 60% in equity for the growth you need to beat inflation and 40% in debt or fixed income to give you stability and steady cash flow. Your specific mix, though, that depends entirely on whether you are funding that 8-year-old's college fund in 10 years or if you're planning to retire next month.
When you're managing this mix, you've basically got 2 playbooks. Strategic allocation is the disciplined route. You set a target based on your life goals, say that 60-40 split, and you strictly rebalance back to it periodically. You sell what went up, you buy what went down. Tactical allocation, on the other hand, is much more dynamic. You're shifting your percentages based on current market valuations. Maybe you move to 70-30 because equities are looking cheap. But fair warning, that requires vastly more skill and market timing.
Which brings us nicely to Section 3, the mutual fund advantage. finding your professional guide. Look, trying to navigate all those allocations completely on your own is dangerous. For most of us, do-it-yourself investing is just a recipe for disaster. And that is exactly why you need a professional guide and a reliable vehicle. Now, a mutual fund is not some new, separate type of asset. You aren't buying a different product. You are simply utilizing a highly efficient, professionally managed vehicle. It's a trust that pools your money with thousands of other investors to go out and buy those underlying asset classes, the equity, the debt, the gold, all based on a very specific pre-stated objective.
By pooling your resources like that, you suddenly unlock these incredible institutional-level benefits. For literally as little as 500 rupees, you get affordable portfolio diversification. You instantly own tiny fractions of dozens, maybe even hundreds of companies. You get economies of scale, which drives down transaction costs. You get high transparency with mandatory daily updates. And crucially, you get liquidity. You can easily access your money without the absolute nightmare of trying to track down a buyer yourself.
So how do you track your specific slice of this giant pool? That's where NAV, or net asset value, comes in. This is the true daily worth of a single unit of the mutual fund. Every single day, the fund takes all the securities it holds, prices them at their current market value, which is a process called mark-to-market, deducts the operational expenses, and then divides that by the number of units. That NAV tells you exactly what your custom slice of the pie is worth on any given day.
All right, Section 4, Exploring Mutual Fund Types. Let's customize your investment vehicle.
Because mutual funds are basically just vehicles, they're obviously different models built for different terrains. First, we have to look at the mechanical structure of the fund, because that dictates exactly how you access your money. An open-ended fund is perpetual. You can buy or sell units directly with the fund on any business day at the current NAV. A closed-ended fund has a fixed maturity date. You buy in at launch, and if you want to exit early, your only option is trying to sell your units to another investor on a stock exchange. An interval fund is kind of a hybrid. It opens up for direct transactions only during specific predefined windows.
Next up, the market regulator, the Securities and Exchange Board of India, or SEBI, mandates strict categorization so you know exactly what engine is inside your vehicle. Equity schemes primarily invest in company shares, aiming for long-term capital appreciation. Debt schemes invest in bonds and money market instruments, where the objective is safety and regular income. And hybrid schemes blend the two, giving you a balanced risk and return profile right inside a single fund.
Now, within those categories, you've also got to choose a driving style. Actively managed funds rely heavily on a professional fund manager's skill and research. They are out there picking specific stocks or bonds, trying to beat the market average. Because that requires more work, the fees are slightly higher. Passive funds, on the other hand, like index funds or ETFs, don't even try to beat the market. They just use algorithms to mirror a market index, like the Sensex. Because it's all automated, your costs are significantly lower. Finally, Section 5. The legal safety net. This is your ultimate shield.
Okay, it is completely natural to be thinking right now, if I hand my hard-earned money over to this vehicle, how do I know it won't just be stolen? The answer is a brilliant legal hierarchy designed specifically to protect you. It's built on a strict separation of powers. The sponsor is the company that establishes the mutual fund trust, but the sponsor doesn't actually hold your money. The trustees are appointed independently to govern the trust and protect your interests. Then, the asset management company, or AMC, is hired to make the daily investment decisions. But guess what? Even the AMC cannot touch your actual stocks and bonds. Those are held securely by an independent fourth party called the custodian. Literally no single entity has total control.
And sitting right at the very top of this entire structure is the overarching watchdog, SEBI. They mandate the strict transparency you get. They dictate exactly how funds must be categorized so you aren't misled, and they even place strict legal limits on the maximum expenses an AMC is allowed to charge you. They are the referee, making sure the game is played fairly.
And this is absolutely crucial to understand. We have to impart the facts neutrally here. While SEBI and this whole trust structure protect you from fraud and mismanagement, they do not protect you from the market. As the source material explicitly points out, a mutual fund is not a guaranteed return product. It is a pass-through vehicle. The profits and the losses of the underlying assets pass straight through to you. You still bear the inherent market risk.
Which brings us right back full circle to the most important question you can ask yourself today. Does your current investment setup, your specific mix of savings, equity, and debt, actually match your life's true why? Take a hard look at your portfolio. Are you taking enough risk to fund that child's education and beat the thief of inflation? Or are you maybe taking way too much risk with the cash you need to buy a house next year?
Evaluate your setup, utilize the proper vehicles, and go take control of your financial destiny.